When it comes to real estate, the cycle, of course, is a little bit elongated. It's a bit more cyclical than other asset classes, and it's also somewhat more interest rate sensitive. So if you look at EQT, actually, across our asset classes, we started leaning into the private equity and infrastructure markets at the beginning of 2023. We started leaning into our real estate business at the end of 2023, beginning of 24. So, we believe that the cycle is about to turn. Interest rates are stabilizing, inflation is stabilizing, and we find interesting opportunities, particularly in logistics and multifamily.
Let's look more broadly at what's happening in the markets, because there's a lot of conversations about deal making, potential IPOs. Last year, you suggested that this was actually, and I quote you here, a no lending period in terms of deal making. Has that changed? Are you a lot more positive in terms of deal making and potential IPOs at this stage?
Yes, I am more positive. I think we're in a real recovery now. If you start with the credit markets, I talked to my colleague the other day, he said they're actually hot. Maybe that's an exaggeration, but if you look at all the sources, syndicated loans, bank loans, private credit, high yield, private high yield, they're all available and open, and there's a lot of competition. So base rates are stabilizing and margins are coming down. So that's facilitating deal making, and I think the deal making will start to increase as the year goes by. When it comes to the public markets, the IPO market is open for larger, high-performing companies that are easy to understand, where the equity story is crystal clear. It's not yet open for, call it the medium-sized companies, or where the stories are a little bit unclear.